Another couple of the key points you'll see there, and as we saw in that game, was that the media adds to the hysteria. We saw pictures there of doom and gloom, of talk of crashes and recessions, and certainly the media builds that up. You'll also see, as we saw with the widgets, that towards the end of a speculative bubble, people always say it is different this time. Something has changed, whether it be widgets or, say, for example, computers back in the tech boom. Something has changed that has changed the old growth rules. Computers or widgets have so revolutionised our world that the old growth rates have gone out the window. And perhaps to some extent that question could be made of China at present, but whether we're at the end of that or not is yet to be seen. So how can we benefit from this knowledge? Well, first of all, if we realise that the market moves based on psychology as well as fundamentals, we can be alert to the fact that that is going to occur. And if we can find areas of times where people are getting too optimistic, we know to reduce our exposure. Vice versa, if we find that people are far too pessimistic, that people are talking about how much has been lost in the market, how we're about to head into a huge recession, how companies are going bankrupt and so on, maybe that's a good time to start looking at increasing your exposure. An old adage that Warren Buffett, who is the world's greatest investor, and an old adage that's a favourite of mine is, be fearful when others are greedy, and greedy when others are fearful. And that quote really neatly encapsulates everything that we've gone through in today's webinar. Before we go on and have a look at a favourite graph of mine that really neatly encapsulates lots of the things we've been talking about today, I would just like to highlight the fact that at the end of this webinar there is the opportunity to sign up for a free Hudson report, and that comes out every week. In addition, you can also arrange a free consultation with myself or alternatively another advisor here at Hudson's. We offer a really large range of services, and I really do value the advice and the services that we offer our clients. Okay, so now on to this graph. When you look at this graph, basically what it was a survey where they asked the participants, suppose you personally had some new savings. Which one of the following do you think would be the best thing to do with your money? And they could either choose to invest it in cash, they could pay off debt, invest in real estate, shares or superannuation. And what I would recommend is spending some time to go through this graph, but I will point out a couple of key things. Basically, you want to be doing the opposite of what anybody thinks is wise. So when most people think it's the wisest place to have your money in cash, don't. And vice versa, if they think it's the worst time to have money in cash, then maybe it's time to start putting your money away. Going back to late 2007, we can see it was one of the lowest times for cash as being one of the best places to invest. And yet at that time, people were getting more than 8% in interest. Going further to the right, only 18 months later it can be seen that the amount of people that thought it was a better time to invest in cash had almost doubled, and the rate of interest on cash had actually more than halved. You were getting down around the 3% mark. Vice versa, if we look at the share market and also superannuation, both of those late 2007 were experiencing relatively high levels of optimism about how good it was to invest in those two assets at that time. At that time we'd been through a very lengthy period of 20+% returns in the share market, and people were obviously optimistic. However, come 18 months later, the share market down 54%, and yet again the amount of people that thought it was wise to invest in shares or superannuation had almost halved, and yet the market had become more than 50% cheaper. So at that time, with the market half price and the interest on cash giving us half of what it was 18 months ago, all of a sudden everyone thought it was the best idea to be in cash. And that will apply right back through that graph. And so whenever you see that people are becoming overly optimistic, it's a time to become very pessimistic and to look at the more conservative assets like cash. Vice versa, if people are fleeing the stock market or the property market, that's the time to be investing. And that's really what the psychology of investing is all about. Staying away from that herd mentality and being aware that just because an asset has been performing well in the shorter term does not mean that it's going to continue to do so over the near future, no matter how positive the press may be at any one time. So I hope you've enjoyed that webinar on investment psychology. It's certainly a fascinating field, particularly for those of you that have been concerned about investing in shares or perhaps have invested in shares and have been burnt before. Because remember, everybody or almost everybody suffers from these same psychological issues. Not only individuals, but the big fund managers and the stockbroking firms all have the same issues. And so it gives you and I, as a small retail investor, an advantage over everybody else. And so if you are aware that the market does overshoot and people do get overconfident, and vice versa, that they get too fearful at the bottom and they oversell, it gives you an advantage over everybody else. It gives you the ability to profit from other people's mistakes. So I hope you've enjoyed it. Please take up that offer of the free consultation, and I look forward to chatting to you soon.